So a warm welcome everyone, and thank you for joining this Hardman Co Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's investment case and to question the management. And the next company is Henry Boot. It's a main market listed company, it's a market cap of £380 million. It's quite a unique group of companies because it creates sustainable value and long-term growth through several routes in land, property and development and construction. The business acquires land without planning permission, obtains planning permission, develops sites and maintains an investment portfolio. And we're really pleased to be joined today by both the Chief Executive, Tim Roberts, and the CFO, Darren Littlewood. Without further ado, let me hand over to Tim.
Thanks very much, Keith. I'm going to start off with our investment case. Then I'm going to give you a summary of our strategy plus our main objectives. And then I'm going to hand over to Darren, who Keith has said is our finance director, who will briefly go through our key markets and our operations. And then you get me again to finish off on outlook. And Darren's going to be my compare on my slides, Darren. And we're going to go to the investment case first of all. We're focused on three key markets: industrial and logistics, residential, and then urban development. And the good news is that those markets benefit from structural tailwinds. We've got a very long record of managing our gearing and balance sheet effectively, and we've come through COVID in a strong financial position. And at the moment, we've got a very strong balance sheet and no gearing at all. The way we conservatively account for our assets means there's significant embedded value across the group. And also, we believe our portfolio is rich with opportunity. And I'm going to go through that in a minute. Now, if you look at the graphs on the right, you can see that, first of all, we've had attractive net asset value per share growth, call it over the last 10 years, but it goes back a lot further than that. And we've also grown our dividend. In 2019, like many companies, we reduced our dividend, but we are now going to grow it again. And between 2019 and 2020, we grew it by 10%. And if you look at the way the net asset value has grown and the fact that we've got a progressive dividend policy, not surprisingly, we generate a good total shareholder return. And our total shareholder return is 13.6% per annum over the last 20 years. And I've not picked that because it's a convenient time period. I've picked it because it's a long time. And if you were to invest in the FTSE, you'd have got 4.6%. So we've performed well. Now, turning to strategy, I'm a relatively new CEO, so it's natural for me to review strategy. And the great news is that the business is in good shape. So it's more about me evolving and the team evolving the strategy. And we do have a need just to tighten our focus on some of our strategic objectives and also get more scale in our three key markets. We've got good operating knowledge and skills within the main businesses. The main businesses are highlighted there. I'll go through them. Strategic land, which Keith has told you about, where basically we control greenfield sites mainly. We then obtain planning and then sell on to house builders. We've got a property investment and development business. The development is focused on industrial, which is a strong market at the moment, with some urban development. And that business also runs an investment portfolio, which is made up of completed developments that we've chosen to retain or investments that we are going to purchase because they have some form of redevelopment potential. We've also got a joint venture, which is a regional premium house builder. And that's relatively small, but we've got a clear plan for growth. And I'll talk about that in a minute. And then finally, a construction division, which has a long, uninterrupted track record of profitability. Now, as part of the strategy exercise, what we identified is that we can grow our capital employed. And our aim, and we've been open with our shareholders about this and our teams, is that we want to grow our capital employed by around 150 million. So it'll be just over 500 million. So that's significant growth. We're talking about growing the business by over 40%. We're confident that we can fund that growth by retained earnings plus a conservative amount of gearing. We will be a conservatively geared business. And along the way, we expect to generate attractive returns on capital employed. And you can see our target ROCE is between 10 and 15%. And a key part will be our ESG and people strategy. And to be open with the team and our shareholders, we've set out targets, which are on the next slide. They're clear. We want to grow the strategic land business so that it sells an average 3,500 plots per annum. We want the development business, bearing in mind that 80% of its pipeline is in industrial. And as I've said, that's a strong market, and Darren will talk about that in a minute. So we believe that there's market demand to grow that to 200 million per annum. Our plan is also to restore and then marginally grow the investment portfolio to 150 million. And the reason why we need to restore it is that, and it had nothing to do with me, but I'm pleased to say that we halved the size of the portfolio by an exceptionally well-timed sale of £70 million late in 2019. Well done, Darren, you take the credit for that. And then we've invested it operationally in the capability of our JV house builder. We're growing its land bank and the strong demand for its premium product. And we want to scale up. This is an example where I need more scale. And we have a clear plan to get to 600 units per annum. And then on construction, there the emphasis is going to be keep on doing repeat work. It's a very steady, conservatively well-run business, and it's got a big focus on public sector clients, which is a good place to be going forward. And then, as I've said, there's embedded value within the business, as other than the investment portfolio, we do not mark to market our assets. So our balance sheet is conservatively assessed. And what I've said also is that we've got a portfolio rich with opportunity. And the good news is, as Darren goes seamlessly to the next slide, is that we can deliver this growth by mining the opportunities that are already within the portfolio. And I'll go through this quite quickly. But strategic land, we have a staggering 16,600 acres of land that we control. That's an amazing amount of land. Development pipelines, 1.4 billion. Our share, because some of it's in joint ventures, is 1.1 billion. 78% of that pipeline is in industrial, strong market. Our Yorkshire based house builder has a land bank of 1,119 plots because we've been investing in that. And that's around Yorkshire, but we've got an ambition in the short term just to operate in the northeast, and we've bought our first site in the northeast and more to come. And then construction, that's got limited capital employed. We're going to remain focused on the public sector work. And the good news is that we've started the year, we've already got a full order book for this year, and we're building up next year's order book. So lots of opportunity within the business. And then, as I've said, an important part of our strategy will be our approach to ESG. And here we're in two phases. The first phase is that we've launched, under the banner of 135 Henry Boot, our community partnership plan. We did that in March of this year. We've also announced our equality, diversity and inclusion strategy. And then in June, we're going to announce our pathway to net zero carbon. And that's all in the first phase. And then on the second phase, we're going to look at the whole. And this takes longer for us to do because we've got to engage in our people, all our different stakeholders. And we want it to be at the heart of the business. That will be completed in January of 2022. And with that, I'm going to pass you over to Darren.
Thank you, Tim, and good afternoon, everyone. If I can now take you through a closer look at our markets and why we believe They offer long-term sustainable returns. Starting with industrial and logistics sector, we continue to see this as a strong market, which has demonstrated a material increase in demand. The 3-year rolling average for big box uptake continues to trend upwards, with around 50 million square feet of space taken up during 2020, being a record performance. Statistics show that the internet sales as a percentage of retail sales have significantly risen also due to COVID. However, we see this as an acceleration of what was already a clearly identified trend in the chart on the lower right there, leading to a continued increase in demand for warehousing, logistics, and last mile delivery. We also expect onshoring of supply chains to continue and support demand in this market as we emerge from the pandemic and businesses consider supply chain risk. Within this market, 78% of our pipeline of opportunities are in industrial and logistics, and we have potential to deliver around 10 million square feet. In value terms, 50% of this is in big box and 28% in small to mid-size units, mainly focused in the North and Midlands, but also some in the South, which are served by our London office. In addition to this, we have urban residential and urban commercial sites, which are generally located in the main regional cities, which will be dealt with by our regional office network and in the market I'll touch upon shortly. We've also concluded a number of acquisitions this year, which will expand this pipeline. Most of our development activity in the short term will be focused on the industrial market, as this is where we see the greatest occupier demand currently. Here we have some examples of the schemes we're currently delivering. At Butterfield Business Park in Luton, utilising group synergies, our construction business is delivering a speculative scheme of 82,000 square feet for our development business, following the successful delivery of an 83,000 speculative scheme in 2019. At Wakefield Hub, we've secured a pre-let for a 260,000 square foot unit to a German pharmaceutical company, and we recently secured planning for a 2 million square foot distribution warehouse on that site. At Phoenix 10 in Walsall, we're undertaking a significant land remediation programme to ready a 44-acre site for development. That's currently one of the largest projects being undertaken in the West Midlands. The residential sectors proved to be significantly robust against the pandemic, recovering strongly in the second half of 2020 and continuing with all of the major house builders noting strong demand and improved results, as annual house price growth hit a 6-year high last year of 7.3% and continues to move forward in the current year. Land values have been relatively stable since Brexit and then continuing with the pandemic, but values are good. Prices have seen some modest inflation in recent years. Demand remains strong, in particular for sites in prime locations and the southern regions. We continue to receive bids for sites at or even above pre-pandemic levels, with the number of bids per site showing a notable increase in some areas. Government support and low mortgage rates continue to support affordability, and with an annual target of 300,000 new homes, the industry has underperformed for some years, resulting in pent-up demand for new product. Our strategic land business controls over 88,000 potential residential plots, with almost 15,500 of these already benefiting from receipt of planning permission. As Tim mentioned, in terms of unrecognised value, it's worth noting that our accounting policy has us value these at the lower of cost or net realisable value, and as such, no recognition of the value gained on the receipt of planning permission is recognised within either the profit and loss account or the balance sheet for these units until they're actually sold. Furthermore, to Tim's comment about our strategic target of disposing around 3,500 plots per annum, our existing stock with planning provides a good springboard to achieve this, with a substantial pipeline of opportunities to backfill as we go. We've also got, as Tim mentioned, a 50% stake in a joint venture house building business. It operates in and around the York, Harrogate and Leeds region. with a residential land bank of over 1,100 plots. We're currently delivering around 125 new homes per annum from this business, which has significant potential for growth and expansion to become a multi-region house builder, delivering a premium product in prime locations. In the urban development market, in the short term, we will focus on the urban residential side of this. As I've already mentioned, undersupply continues to drive demand, and in the younger age categories, individuals continue to seek out rental accommodation in urban areas close to work and which provide a living experience. In the short term, we will have a focus on the build to rent market, which currently accounts for only 2% of the total private rented sector stock. And following the recovery in construction output, we will continue to both develop and build product in this space. Longer term, we believe the workplace is not gone. COVID will lead to many office environments being reimagined, but as a place for collaboration, training, and sharing of ideas. We strongly believe that our city centres are not dead and will continue to outperform additions to GVA and population growth. We will take a medium-term view of this, but fully believe that quality new product in prime locations will be in demand as the recovery takes hold. Currently, we're delivering Campus, a 534-unit build-to-rent scheme in Manchester for an international fund in which we retain a 5% equity stake or 11 million in GDV terms. In Sheffield, we've been awarded a construction contract for the Kangaroo Works, a 364-unit build-to-rent scheme with a contract value of around £40 million. And at Cornwall House in Birmingham, a site we acquired last year, we hope to receive planning shortly and start on site with a £32 million build-to-sell scheme in the second half of this year. Finally, I'll hand you back to Tim for an overview of our outlook before Q&As. Tim.
Thanks, Darren. So just to finish off, we've seen a steady recovery in our markets. Our balance sheet is rock solid with no debt. And from this position, we've been able to make selective investments, which will be profit for the future. In terms of the short-term outlook, we've had a very good start to the year, with having already pre-sold over 2,300 plots in our strategic land business. Our committed developments are 88% pre-sold or let, so we've got capacity to commit to other schemes. Our JV house builder has secured 57% of sales of its year's target already, and a construction order book that's full. And in the long term, we're very much focused on the three sustainable markets: industrial and logistics, residential and urban development. And we've got clear medium-term objectives to grow our business, and I'm confident we can achieve those and continue to generate attractive returns to our shareholders.
Now, the first question is basically, I think this is Tim. Any CEO who takes over a business before pandemic strikes must have learned a lot of factors. Despite the fact that you've talked about your strategic objective, what have you learned about Henry Boot and the people that work there? And is finding adequate human resources a limiting factor in your growth for expansion? Sorry, that's a slightly complex question.
No, well, I think that's a great question, isn't it? I mean, I've found a skilled and engaged workforce, and we've been around for a long time, and I don't know whether our legacy has got something to do with that. What I also like is that there's some commercial acumen. So we find deals, and we've got a long history of generating a strong return on capital employed. And it also means we've got lots of opportunities. And in the real estate business, you sometimes find that companies can't really grow because they can't find the opportunities to do it. We've done that, and I think I've given you a good glimpse of all our opportunities. I think just to be balanced, I think that the business has now big enough so it needs to be clearer on its strategy. And I hope by letting you all know what our ambitions are and setting them out, and we will mark ourselves against those ambitions with being clear. And in terms of HR, I think that the market will become more difficult to attract people because the economy, I suspect, is going to be pretty strong. But if you keep on managing to treat people properly, treat customers properly, give people interesting projects to do, deal with them properly, which Henry Boot's got a great doing that. Do you know what? You'll find people.
Okay, so the next question relates to your recent acquisition activity. So Henry Boot has made a number of real estate investments in recent weeks. Are you buying when others are fearful? And is the risk profile of the group changing?
Yeah, I think that because we are focused on three markets that have got through the pandemic pretty well and have definitely got long-term sustainable characteristics, we wanted to, first of all, get through the first part of COVID safely and securely, and then we wanted to invest some money. And we started to do that in earnest in the second half of last year. And what I think you're seeing in the flurry of press statements on us buying a beautiful prime site in Birmingham and 2 industrial estates is the result of that work last year. And we bought things last year. We bought nice income producing buildings with redevelopment potential in Manchester and Leeds last year, you know, great cities in the north. So I think that it's a lovely question because it pays us a compliment, doesn't it? But we're not the only people doing it, but we're in a good position. And then in terms of risk, no, we will carry on being thoughtful about risk. The big thing that real estate businesses have got to be thoughtful about is gearing. And we will either, at the moment, we're not geared, but as we grow, we will gear, but we will be conservatively geared. And as we take on operational risk, because the gearing is financial risk, as we take on operational risk, we'll be thoughtful about the levels of our pre-sales and the levels of our pre-lets and the levels of land that we've got planning. And again, I think that in the operational update that Darren gave you, you can see that every time we're buying something, we're also thinking about passing on some of the market risk by pre-letting, pre-selling or reservations.
So the follow-on question from that is, are you in competitive situations when you're making acquisitions, and how do you decide where the max limit on pricing is?
Yeah, well, we are in competitive situations. I'll give you the 3 markets. So industrial is very competitive. So if you want to buy an oven-ready piece of land, you would be competing with lots of developers and institutions and American and Canadian pension funds. If you look at what we're doing, we've got some oven-ready stuff, but we're making it and we're baking it. And that's what we will do. We will buy stuff that's more complicated. And yeah, Darren talks about Walsall. There are not many people with the skills to remediate that site. So that's competitive, but we'll find our niche. Residential, that again, pretty competitive, but we're either long-term buyers in strategic land, which is less competitive, or we know our onions in Yorkshire and then on urban development, I think urban development is the part that is not so competitive because people are a bit worried about the cities and the fact that the pandemic seems in the short term to have moved people out. And we will buy some interesting sites. We've bought some interesting sites. And as Darren said, look, I think that the idea that this trend that's been going on for 2,000 years of cities growing, I think the idea that cities are going to start to shrink, they might, but over the medium term, there are too many attractive things in the cities that will continue to attract businesses, institutions, and people there.
So in the industrial and logistics area, what factors do you consider when deciding whether in fact the sector is getting quite hot? In other words, there's a huge amount of capital coming into a limited market and you decide the value isn't there anymore. Are we anywhere near there?
Well, you got to look at macro supply and demand first of all, and at the moment the macro supply and demand looks as though it's balanced, and if anything, in favour of the provider. Then you've got to look at the micro markets, and there might be a lot of supply across the country, but I'm making this up now. No supply in the Eastern Midlands, so we will study that market. We will also, notwithstanding those supply and demand characteristics, we will look at the returns that we can make. And typically that will be an internal rate of return or a return on profit. And we're experiencing this now. There will be some sites that we put bids in for and don't get them. And there will be some sites where we don't even put bids in. And I think that what happens is as the market becomes stronger, you become more selective about what you buy. And look, it is a strong market, but it is a long-term market. And don't forget, Henry Boot has got a big pipeline. So a lot of our opportunities were bought when land was cheaper. And land is the big variable. Yeah. So if the end price goes up a lot, the cost of building it doesn't go up a lot. It's the cost of land, and we've got that land, or we control that land already. So look, I think we're in a good position. Okay, so
we only got time for one more question. It's about house building, and the question is very simple. Would you like,
Darren, this is coming your way because you definitely answer a question.
Okay, so it's the same. It's a similar question for house building. How exciting is house building, and how?
Darren, go on. You know the answer better than me in any event.
House building's an incredible market at the moment, isn't it? All of the house builders post-pandemic have come back into the market. They're showing good results, good levels of demand. We're seeing that in our house builder. As Tim mentioned, we're 57% reservations taken for the full year already. The market itself is probably constrained by the ability to gain planning permission and the difficulties of that system in the UK. And if that can be eased up, then that would hopefully allow the UK to start delivering the kind of numbers and targets that it's looking for. For us, it's a really exciting time at the moment with our house builder. We're looking to expand it into the Northeast, following that into the Midlands. And as Tim's alluded to, we think over the medium term, we can get that business up to doing 500 or 600 residential units per annum.
Gentlemen, I'm afraid that's all we've got time for. Thank you very much indeed.
I hope you've all found this afternoon's event helpful. I'd like to thank all of our speakers for their contribution today, and you, the audience, for taking part in the forum, and thank you very much.